And I'd like to welcome everybody to the real estate investing market, current and future outlook. We are waiting for one more panelist, but I am your MC, Jonathan Schein of the Real Estate Limited Partner Institute. And I'd like to welcome our current panelists, J.D. Sitton of Hines, Allison Yeager of Mercer, and Jeff Beckham of General Investment and Development, also known as GID. Welcome. Thank you for joining us today. And so let's jump right in. Obviously, real estate has been impacted and has had a huge impact over the last year during COVID, but it still remains a solid, viable investment as an asset class. Now, also, we're going to go drill deeper down after we talk about real estate and how it is affected in terms of DEI and ESG. So why don't we just start with Allison, as you, you're sort of the gatekeeper at Mercer in terms of your customer base. When you're talking about real estate, it can mean a lot of things. How do you define investable commercial real estate, and what types of assets are included? And this is a question starting with Allison and then for the rest of you. So Allison, why don't we begin with you?
Sure, no problem. So we define real estate as physical real properties, and it stretches across a variety of different sectors and obviously geographies, including multiple types of housing. In the residential category, apartments is one that most people are most accustomed to, but could be student housing, senior living, could be manufactured housing. Single family rental is now part of that as well, all the way into office and the various types that you would find in there: medical office, life science, stretching into industrial. So really any physical property that is leased and used by either a tenant for whatever purpose. And we define it separate from real assets. So real assets would then encompass other things such as timber-related investments, agriculture-related investments, potentially even infrastructure-type investments, energy, et cetera.
Okay, thank you for that. Now, I'm just going to go to Peter, and you missed the first part of the question, but really is, how do you define real estate as an investment class? And obviously, I forgot, you're with Nippon Life, Global Life, so you just joined us. Thank you, Peter.
Of course, sorry about the delay, a little technical difficulties in this virtual world, but I think really from what I heard of Allison, very similar, really looking at the physical asset, defining it as the ownership and focused on getting the return partially through the lease as well as the capital appreciation. And recently, as I also cover infrastructure, we really had a deep dive with data centers. That's one area that really crosses the line. And so we had a deep thought internally and discussion about where do we draw that line? Because there's PE groups, there's real estate groups and infra. And really the decision was it's where you own the physical asset, where you're getting the lease, but you're not involved in the operations. And so that really applies across our real estate definition. We really do not want to be involved in the operations. We see that as too much of a risk for our real estate portfolio.
And just to give some perspective of the size of the AUM, or in other words, the size of Nippon Life, how large is the investable universe, and how big of a portion does real estate pick up on that?
So in terms of what I am managing at the moment, we have about 1.5 billion under management in the US and Europe, and roughly 70% of that is in the US, 30% in Europe, which relative to the overall Nippon AUM is actually very small. Nippon Life has about 700 billion under management. And so Nippon recently has made the decision to really push into real assets further. So within our real estate, we were allocated an additional 2.5 billion at the very end of 2019 to deploy over the next 2 years. So we've got about a year and a half left with which they want us to try and get it out once we take into account the impact of the coronavirus and the time lost. But with that, Nippon wants to aggressively grow, and within about the next 7 to 8 years, would like to have about 8 billion under management in real estate.
Okay. Thank you. Before I unleash the managers on you, I'd like to just ask you: there was a session earlier where data centers did come up as part of an asset class that's not being invested? It's a real estate asset, but are there some product types that you're just staying away from at this point?
So for us, we have really been in the traditional sectors, looking at office, residential, retail, industrial, historically. And so going forward, we see the opportunity in retail and office. Our retail, of course, is very hard hit due to the growth of e-commerce, but office, we see the uncertainty of the impact of work from home and everything else that's coming out of the coronavirus, and the idea of downsizing these companies and the amount of space they need to lease. And as we continue to see, industrial is a very strong sector. Residential is also up there, but we've started to push into alternative sectors. So senior housing, student housing, data centers, medical office, and we see those as very attractive, strong yields that would complement our portfolio. And within that, the newer ones, we're a little cautious. We're a little slow to move into those. So we really try and understand, research the sectors. So data center, while we do have some exposure, we are cautious about going into a dedicated fund. Life science, similarly, we would like exposure, but not a heavy exposure. So as we continue to research down the road, we might make a dedicated fund investment. But for right now, we are happy with a diversified.
Thank you for that.
So
I'd also like the audience to know, because real estate has never been a big part of this Compass conference, and we're trying to make it a little more robust. If you have questions, please funnel them in. These are professionals and we're happy to answer your questions. So in honor of St. Patrick's Day and the fact that General Investment and Development is actually based in Boston, I'd like to bring in Jeff Beckham from GID Group. And first of all, I'd like to hear from you. What kind of questions are you hearing from investors when you're actually talking about your funds?
So, we're in industrial multifamily. From the multifamily perspective, obviously, the biggest question is, are people paying their rents? And what are your collection percentages? For the assets. That's a number one. I think across the board. And outside of that, we're looking at, outside of leverage levels, our ability to deploy fresh cap, because it is a very competitive environment. There are a lot of funds out there investing, and multifamily is one of the hotter asset classes, as is industrial. And so our ability to buy at appropriate metrics that we feel that there's returns.
Okay, so that brings up an interesting question, because some of the investors that obviously invest in these funds are state pension funds, Taft-Hartley, unions, and some of the unions are investing in funds that could potentially evict some of their own actual members. How do you address that? JD, how is that being addressed? Whether, I don't know if you have Taft-Hartley in your funds, but how would you address that to some of your investors?
We don't, but the first and foremost, what you have to do is you have to be a fiduciary for your investor, which for everyone's benefit, that means that you have to act with the best interest of your end investor first. And if that means that you need to evict a tenant, be it a potential member of a union that may also be an investor, that's what it means. You need to look after the interest of your investors first.
Okay, and Allison, are you getting some of, we've discussed this before, what kind of feedback and pushback are you getting on that?
I was going to add in that we've had a lot of discussions with the investment managers that our clients invest with over the last year, obviously, and they've done a great job to really work with tenants, whether it's in apartment buildings and it's a single person or a corporation or some other type of entity that's leasing space in an apartment or an office building, to really try to make sure that, they kind of, the managers are really working to improve the S in that ESG, and we talk to them a lot, couple on this call heard me say that at the beginning of the pandemic, this was a great time. We've all focused in the real estate world on the environmental aspects, but this was a great time to show there had been a lot of focus on social and governance as well, but this was an opportune time to do it. And we saw a lot of managers do a great job with that to not rush right to eviction. I know JD is just describing the process, but I know that's not what they did. If they had that situation, they worked with the tenants to really try to make sure they took advantage of any sort of program that was available to them to keep them in their space if that was, something that they could facilitate.
Absolutely. And, JD and Jeff, I know both of your organizations basically set up help desks to work with tenants and help them work through the process. Perhaps Jeff and JD, you could further this conversation along and showing what actual fund managers and real estate professionals do to help their tenants along.
Yes, I mean, we've, in addition to help desks and making sure that tenants have the all the access to the support, that they need. But, to give an example, in Texas with the storms that just hit, we rolled out what we called the warm bus. Residents could come in and warm up. We actually took one of the pools at one of our one of our buildings and actually let tenants access the water from the pool to boil, and water was unavailable, and we actually our platform, we had folks from different cities, even as far as Atlanta, where we own assets. So we needed plumbing supplies, which were hard to get, hop in the car and drive all the way out to Houston and Dallas and Austin, where we have assets, to be able to have the supplies there. It was really an effort to roll up our sleeves and make sure that you're putting the tenant first, which is a big part of generating goodwill with the communities.
Thank you. And JD.
Yeah. So for whether that were directly impacted, if you lost your job and you're a tenant in our building, there was immediate rent relief provided to you. And if you're a commercial tenant, we renegotiated those leases, providing free rent for an extended period of time to sort of get the tenant through the disruption to their business. If you're dealing with a long-term viable tenant and or a good rent-paying individual, if you will, it's in no one's best interest to play hardball, so to speak, and not work with good tenants to get them through a crisis moment that everybody is sharing. It's not good for the landlord, and it's not good for the tenant.
I mean, there was a lot of headline that 3 million people are going to be evicted, and still a headline. It actually hasn't gone that way. Peter, obviously, as a global investor coming from obviously Japan, how is that viewed upon here? And I also want to get into the E of ESG, because I know that your company is starting to move along in those ways as well.
Sorry, I missed the very last part. Could you repeat that?
I was talking about how Nippon is moving along in the ESG aspect of real estate as well as they go into investing.
Exactly. So it has been a big push for Nippon over the last 3 to 4 years, where Nippon has been a signatory to the UNPRI to try and get involved in the sustainable development goals and whatever type of activities with respect to real estate. The social and governance is a little bit harder to control. Really, the environmental is an area that we are trying to make an impact. And it's something that we have had a lot of discussion about. How can we enforce it? What is it that we are looking for? It's still early days, relatively speaking. As an investor, I realize that Europeans are much more advanced with regard to the environmental aspect of ESG. But as an Asian investor, Asians are, for the most part, a little bit behind, but we're coming up relatively quick on focusing on it in our investments. But one of the challenges has been trying to decide, where is that line? It's not a make or break right now, but we definitely want the manager to be focused. And as an example, we have looked through a lot of managers, and there could be a manager that when you're reading through the document says that they have an ESG policy. Yet I've been meeting with the manager, met with the head of asset management, and when I asked, what's your ESG approach, to really dig in, the response was sort of a blank stare of, well, what's that? So they can say it, but the action doesn't necessarily line up. And at the same time, it's easy to point to being a signatory of the UNPRI or participation in the Global Real Estate Sustainability Benchmark, but not every manager has necessarily signed the PRI or necessarily participates in GRESBY. And so one of the managers that I think is the most advanced with regard to ESG and really has done some amazing work. For example, they were redeveloping an industrial site, and on site they ground up the concrete and reused it. So they didn't actually have to really bring in much. They really just recycled it there on plant and were able to develop that new industrial. They have assets that they have used. 69% of the material that went in was recycled. So very impressive, very advanced. Yet they were not a signatory of UN about July of last year. And we've been with them for about 3 years now. So it's a little hard to draw a line and say you have to be a signatory of this or you have to participate with GRESBY. The GRESBY benchmark, while it is a good indicator, isn't perfect. It's still evolving. While it has been about 10 years, we've met with GRESBY and they continue to say that they are evolving. They're trying to evaluate. And so the benchmark itself has skewed a little more towards the environmental and away from the social and governance, which it was focused on about equally initially. And at the same time as they do that, they are resetting scores. And so this year in particular, they did that. And it's hard to focus on just a score. Are you improving the score? So it's an evolving challenge for us, and we're continuing to research it. Since we have made the initiative, Nippon has, of course, made it a big drive to understand what they can do as a company, but also at our level as the investment managers for them. We have met with a lot of consultants, we've met with a lot of the major managers, and really tried to do research across the board. How can we do this? And I think one of the easiest messages as an investor, given we're a bit removed and we don't have the ability to control the exact business plan for the asset, was the idea that the most important thing we can do as an investor is just continue to ask. It will get on the radar of the managers. They will realize they really need to focus on it and improve their efforts just based on asking. And so we've really made a point of trying to dig in and understand what is it they're doing, push them and request them to do more, really get that ingrained in their investment process.
Great, thank you. And I'm looking for questions from our audience, obviously none yet. Allison, I'd love to bring you into this conversation because you vet all the managers and what your customers or clients are looking for in terms of the DDQs, and how does ESG fall into that, and soon we'll get into the DEI conversation, but I'd like to hear just strictly on ESG at the moment.
Sure, absolutely. So we actually have 3 different types of reviews, managers, that you have to go through when you work with Mercer. It's not just investment due diligence. That's a big part of it and what most people know. We also do operational due diligence, but we also go through really ESG due diligence. And when we approve a manager's strategy for our clients to eventually invest in, it provides the client with not only just the investment due diligence rating and operational review rating, and those are separate, but also an ESG rating. So it's a different rating that's provided to look at all those different criteria, and D&I is part of that as well. We found the same situation as Peter, where trying to rely on, obviously we've been very involved with the UNPRI and for years from the beginning of that, and with the GRESBY and trying to use that information, but there's just other information that we ask to try to get the full picture of what the impact and the types of policies that each of the different firms have in place in order to fully assess them most appropriately in those areas.
So JD and Jeff, let's talk about ESG. I know that I know more about Hines, and they've been at the forefront of ESG for about 2 or 3 decades. I'd like to hear about the philosophy behind that at Hines and also the philosophy behind it at GID. So JD, can you kind of illuminate us?
Absolutely. So it really dates back to our founder, Gerald Hines. He was of the view that real estate basically presents or can represent critical infrastructure within a community. And in representing that, he was also an engineer by trade. He believed that buildings that were both aesthetically pleasing and highly energy efficient would command rent premiums over time and have more staying power than their less efficient peers, if you will. And so that's a philosophy that's started when the company was founded over 60 years ago and persists to this day. For example, we have a European core fund that is an open-end fund, and for 4 years running, it has been the top fund in its category for GRESBY. So that gives you some sense of it for Hines. It's really ESG is no longer something that is a nice to do. ESG is something that is an integral part of any investment decision, and any investment going forward needs to be sustainable, not just from an energy perspective, but socially. It needs to be a positive contributor to a community, as well as an investment that's going to generate good returns for investors. And that those two things are not mutually exclusive. Often people think, hey, if you're making a good return, that must mean you're cutting corners. Maybe not at all. Actually, if you want to make premium returns, you sustainability and making investments, if you will, that are high on the sustainability scale. Okay,
so I'm just going to bring Jeff into this, but just for our audience sake, you keep hearing the term GRESBY. Well, it stands for Green Real Estate Sustainability Benchmark. It's benchmarking portfolios against one another in terms of how sustainable they are. So back to Jeff. I'd like to follow up because we have some questions from the audience as well, which we'd like to get to.
Yeah, no, and I'll be relatively quick. I mean, GID has always taken the philosophy with respect to ESG, focus on doing, not just saying, not just responding to putting words down in an RFP. Make sure that the actions are substantive. We do participate in all the relevant programs. We were #1 in our benchmark for GRESBY for 2020, #1 ESG award for PREA in their inaugural year. But you really, our focus has been, we're in multifamily as our largest sector. These are communities. This is where people live, families live, and making sure that they have not only sustainable buildings that have proper air, water quality, energy efficiency, but also social needs given the community. And we look at it within GID as well. One of the things that we're rolling out now is because we are vertically integrated, we have a lot of building engineers who are Hispanic, and English is not their first language. And we looked at how many of them aren't getting the promotions that they should be just purely because of language. So we're sponsoring English classes for those folks who want them, and also for their family members to the extent that they want the English classes as well. So we can get people who are highly educated but just have need this one little bit to really make sure that they're on the every advantage we can give them given their talents, so they can progress and move up through the company. It's a very proactive. How can we be?
Well, it certainly touches upon the S and the DEI, but and we will get to that hopefully if we have time. But a couple of questions from our audience as we talk about first climate change, and then we're actually going to I have a real actual real estate question as well. So first question is, one of the biggest challenges we face is climate change. How, if at all, have real estate markets focused on environmental factors? Looking towards the future, how will this change how real estate investors make decisions? I'm going to go straight to Peter, as he is the real estate investor here.
Sure. So in terms of climate change, it is an increasing focus. And as we invest, we want to make sure that we are protecting not only the assets we're invested in, but make sure that we are putting those assets in a place that's not necessarily going to be impacted in the future, but also limit the impact we have on climate change. So as we focus on the environmental, we want to make sure that the development and what is going into the development of those assets or how the assets are managed is improved, whether that's adding LED or doing various items to the general property, adding green space to help with the recycling of carbon. But at the same time, we also want to protect returns, which we have found is a driver of our managers to avoid spaces that perhaps may face rising tides in the future because they don't want to have to be subject to higher flood insurance. And at the same time, want to protect and make sure that we have a durable asset that will not become obsolete due to climate change. So I think within real estate that you'll see a shift just based on where the capital is going, both from a return, but also from an environmental standpoint.
Okay, now, Allison, what are you hearing from your clients in terms of markets, and markets in terms of whether climate change will affect where they're investing?
Yeah, it's definitely something that is factored into our analysis and our categorization of the ESG component of the real estate managers. So one of the areas that we ask questions about and try to understand what the impact is. It varies, I think, across the client base as to how much of an impact that plays in their investing philosophy. Obviously, Europe has done, a little further ahead, as we mentioned before, in that regard. So see a little greater emphasis in that region than the other. Starting to hear much more from clients in North America. Australia has been pretty focused on it too, obviously, so I shouldn't leave them out of that category.
All right, so back to that. Someone going to say something? I'm just going to get back to real estate because it is a real estate panel. One of our questions is, what are your views of hotel and the hospitality recovery timeline and areas to focus on and to avoid in terms of tourism and business travel destinations? That could take up a whole afternoon because I want to touch on some of the other property types as well before we dive right into DEI. So I'll leave it up to the real estate professionals, Jeff and JD, if you have any comments. Are you in any of these industries, business in tourism, travel, hospitality? JD, why don't you give us a shot?
And here I was going to give Jeff a shot first. I would tell you, Hines is not. We just have a few hotel investments, and they're in Greece. However, there is no question that the hotel sector presents a strong value, I think, and has gotten substantially from a price perspective beaten down, just given the impacts of COVID-19 on both business travel and leisure travel, which has gone down so dramatically. We do believe that there is a fair amount of pent-up demand for these things, and you're already seeing within the hotel space a nascent recovery as the vaccine rollout picks up a little steam. And if you've been to an airport lately, which I have, it's not nearly what it used to be in terms of how busy it is, but it is busier than it has been. And so I do think folks, this question is focused on hospitality. You can parlay that into retail, office. Are people going to come back to the office? The thing to remind everybody of is we are doing this not because we want to, but because we've been forced to. We'd rather be at a conference right now having this event, but that is not possible, right? Soon, these things will be possible, and you're going to see people coming back to the office. Are they going to come back the way it was before? No, it'll be different. We'll have some flexible work arrangements. You're also not going to be totally crammed into an office space the way that workers were being crammed. The office has to be cool, and it has to be a healthy place for you to work in. You've got to want to go work in the office, right? So it's going to change. But getting back to hotels, we see that as a strong opportunity. It is not a strong suit for Hines.
Okay, Jeff, thank you, JD.
GID doesn't invest in hotels, but I will say I think one of the big questions is all of us travel a lot pre-pandemic. It's the nature of the business. How much of that travel, now that we've spent a year getting business done without the travel, I think yes, the interpersonal community relationships. Seeing real estate, we're in a hard asset business. You need to actually see the buildings, but how much of that travel doesn't come back? How much of an investor meeting does that first meeting all of a sudden can be virtual? And then if there's interest, maybe you travel. And so how, it'll be interesting to see. Yeah, business travel, I think, will come back, but I think
we lost Jeff.
70%, 90%.
Yeah. I think we have Jeff. I just heard Jeff. Okay, Jeff is still there, according to the report. So, no, thank you for that. I mean, obviously, we could talk about what real estate will come back. It is coming back. It never quite went away. It's just going to look a little different. As most people say, I really want to get on a plane, but not to get to the office. Right? They want to go on vacation. That's the first thing they want to do. So that's where the opportunities probably lie in real estate investing in terms of that. But let's focus on something which is really important, which is really diversity in this industry. And we're not simply a very diverse industry. And I'd like to, I don't know who to go to first, but I'll start with Allison, because you work with the ESG, you mentioned DEI guidelines as part of the new prongs within the DDQs. I'd like to hear your views on it and how we can make the advancement of bringing more diversity into this industry.
Yes, so this is an area that, of course, I have been focused on for years. As managers would know, ask about this constantly. We're not a very diverse industry at all, and we're working on it, and I think there's been a renewed focus on it, which is good. It probably should have occurred a few years ago. I think the answer is that there's no way to go out and hire, 30% of your senior workforce and all of a sudden become a diverse group. So we've got to focus on the education of the individuals coming up into our industry, all the way back to before the university level, of making sure that, different population groups understand the different types of opportunities available in our industry. And we're providing those through internships in the university. I know our company actually has an internship program for high school students, which is great, because then we can even hopefully persuade them that it's a great industry to go into before they even get to university and have to choose their career path. So those types of initiatives, I know there are some industry organizations that are supporting that as well, which are really great. And the more we can do as an industry to support that, and then have these goals for each firm to make sure that, okay, if we do that and we're able to actually facilitate a population that can be hired into the industry, we've got to hire them and retain them as well, and make sure that they're comfortable and happy in these roles.
Well, Allison, that brings up a big point. Or is it where only Mercer has actual physical offices, or are you able to actually go out beyond that now in the era of COVID and post-COVID in a virtual meeting? Can you recruit people from other other places that would not necessarily be officed by Mercer?
Yeah, that's a great opportunity because it has really expanded our view of where you have to necessarily be located. I do think, and as JD or Jeff or someone mentioned, that we believe that people will come back to the office and it will look a little bit different, but we think the majority of people who used to be in offices will be back in offices. And I think it's, it's important if you're starting out in an industry to have the ability to spend some time with other people physically, face-to-face with people from a learning perspective. But the flexibility that this is going to allow will definitely open up different doors for other people that might not have been opened in the past.
Thank you. It's very important to our audience to hear that the real estate industry, real estate doesn't move itself, so the industry is kind of reflective of the asset class itself. But I'd love to hear, because we're going to be closing in a few minutes, I'd love to hear other perspectives. Peter, you come from a global Japanese investor. And then we'll go to Jeff and JD to close up. But Peter, I'd love to hear your perspectives on the DEI specifically portion of it.
So it's a growing focus for us. It's something that we have found that, unlike private equity, where you are controlling the investment into companies and you can kind of influence a larger pool of individuals, we want to see the managers themselves have diversity. But it's a little hard to enforce that. You can't quite put that in the terms of an agreement when you're investing. But with regard to Allison's comment, I completely agree that it is something that we need to be able to bring in people at an earlier stage. You can't quite hire someone at a senior level just for the sake of diversity. I would love to be able to see it, but just like any industry, you need to grow up from the bottom to be ingrained in it. So I think it's the opportunity getting out to colleges. For myself, the idea of going into real estate was not an available option. It was never communicated. So I think it's the opportunity and the drive of the industry to get out into colleges earlier and communicate that this is a career path that will naturally lead to inclusion at the junior levels. And while not a quick answer, it will trickle up over time and you'll see more diversity included in the senior levels.
Okay, thank you. And you bring up a good point that came up earlier. After all, managers are fiduciaries and returns are that much more important. And so how do you balance that? Jeff, I'd love to hear some perspective on this.
Yeah, I like to piggyback, and I think there's two aspects to creating the change. One is increasing the pipeline, and I agree you have to reach back all the way to high school. And then there's increasing programs that do that, but there's also developing the talent once you bring it in. You can hire 10 analysts who are diverse, but if none of them make it to vice president, nothing's really changed. And there has to be that intention behind grooming that talent and moving them up, because corporate America is not a true meritocracy. A lot of success is driven by sponsorship, mentorship, and making sure that there's appropriate mentorship and sponsorship of these junior people. That's how they make it up through organizations, and that's something that's been missing as well in the industry, because it's all too easy to just hang with who you know and who looks like you, to move them up and getting people to step outside of their comfort zone. But I will say there's more focus on this now than I've seen in my almost 22 years in the industry. So I'm looking forward to what's coming next. But we need to make sure that the accountability stays there.
Well, thank you, Jeff. And JD, finally, we're closing. We're closing within the next minute. So I'd love to hear your views on this. And please.
Yeah, I just want a quick shout out to, as an industry, there are a number of initiatives that we, everybody in this group actually supports, like the Robert Twigo Foundation, that is part of the mandate is to bring forth young candidates that are of diversity backgrounds and foster them and bring them into the industry. So that's sort of a increase the pipeline type organization that I'd like to give a shout out to. And otherwise, I would echo these comments. It takes real intention, and it doesn't happen overnight. I will say that organizations are very serious about this. I can tell you from my own experience at Hines, we haven't talked about this, but the social unrest that we saw over the past year, that sparked some discussions that in the workplace I had never had. And I don't know about the rest of my colleagues here, but we had a forum, for example, on empathy, where we had some of our colleagues from diversity backgrounds, whether they be African American or Latino, talking about their experience in raising their children in America and what they've had to deal with. And I just think it's awesome to be able to have that conversation, which is generally one that if you're not in the diversity bucket, you shy away from it. It is so important that we have these conversations and that we foster talent and that we make people feel important, included, and heard, and part of the family that is corporate America. So that's something that Hines is very focused on. And hey, a shout out to this panel. We're pretty diverse right here. If you don't realize it, there's a Latino on this panel. You've got maybe a senior citizen on this panel. You've got female representation. So I think this is as an industry, we are doing better, but we can do more, and we'll continue to do more.
And that is a fantastic way to close this panel. I want to thank our panelists for joining us this afternoon and making this panel a very successful afternoon at RFK Compass. Thank you very much.